Welcome to today's Explainer. Right now, a high-stakes domino effect is absolutely ripping through global energy markets. Based on the very latest data from July 22nd, 2026, we're looking at a landscape that's being completely reshaped by global events. We're going to break down exactly what's happening, why it's happening, and what it actually means for the broader economy.
Now, to really grasp the chaos on the trading floor right now, we have to talk about the geopolitical risk premium. It is completely overriding normal supply and demand fundamentals right now. Markets just aren't trading on how many barrels of oil exist today. They're trading on the fear of how many barrels might suddenly vanish tomorrow because of political uncertainty, war, or supply chain disruptions.
And the absolute epicenter of this entire global chain reaction? The Middle East. The stakes honestly couldn't be higher, and this tension is visibly spilling right over into physical commodities.
So here's our roadmap for today. We're going to cover the geopolitical crucible, the crude oil shock, the natural gas divergence, macroeconomic impacts, and finally, forecast and strategy. Section 1. The geopolitical crucible, the epicenter of market chaos. It really comes down to geography, right? The Persian Gulf is pumping out about 20% of the entire world's oil. We're talking tens of millions of barrels a day. With broken ceasefires and direct airstrikes between the US and Iran dominating the headlines, there's this permanent, looming threat to critical maritime choke points, specifically the Strait of Hormuz and the Bab el-Mandeb Strait. And the market isn't waiting around to see if these choke points actually close. They're aggressively pricing in the absolute worst-case scenario today. Moving to Section 2, the crude oil shock. Prices surge to multi-week highs. So here is that first falling domino. That geopolitical premium is literally slammed into Brent crude, pushing it to a staggering $94.20 a barrel. And it's not acting alone. US WTI is following close behind, trading up around $87.30. These aren't just your standard incremental bumps. These are massive leaps driven purely by headline risk. The sheer velocity of this move is just staggering. Throughout July, the physical oil market hasn't been sitting around waiting for an actual ship blockade. Traders are looking at the escalating conflict and just hammering the buy button to secure contracts before prices go even higher. News is entirely leading the price here, completely overtaking any normal physical supply and demand logic. Section 3. The natural gas divergence. A stark contrast between East and West. Now this is where the story gets incredibly fascinating. While crude oil is surging basically everywhere, natural gas is literally splitting the global market in two. Over in Europe, there's a desperate scramble. Because they rely so heavily on liquefied natural gas imports from the Middle East, all these maritime threats have triggered a huge wave of panic buying. They're rushing to fill their winter reserves at any cost. Meanwhile, the United States is actually drowning in domestic oversupply. Why? Well, massive export facilities like Freeport LNG are down for maintenance. So the gas is effectively trapped inside the US, totally unable to be exported to a desperate Europe. And you can see this physical disconnect directly in the pricing. Europe's Dutch TTF index has rocketed past 62.1 euros per megawatt hour, which is a multi-month high. But over in the US, the Henry Hub index has actually plummeted over 14.5% this month. It's just hovering quietly near $2.90. It's a tale of two entirely different realities, based purely on geography and infrastructure limits.
Which brings us to Section 4, macroeconomic impacts, inflation returns, and energy stocks boom.
Because these aren't just lines moving on a screen, right? They dictate the entire global economy. Energy is the foundational input cost for, well, basically everything. Because of this massive spike, the ghost of inflation is officially back, and it's seriously worrying the IMF. For investors, and honestly everyday people, this means the Fed and the European Central Bank might be entirely robbed of their hopes for early interest rate cuts. They just can't lower rates if energy is driving inflation right back up. Ironically though, while the rest of the broader market sweats, energy giants like Equinor are seeing their profits absolutely skyrocket, acting as a rare safe haven in this current storm.
Finally, Section 5, forecast and strategy, navigating a highly volatile market.
So, what's the actual actionable takeaway for us here? Let's map out the timeline. In the near term, remember that in a war-driven market, headlines matter way more than physical barrels. We're seeing $90 per barrel become this new, really solid psychological floor. Moving into the medium term, with these continuous disruptions in the Strait of Hormuz, we're on a fast track to test the $95 to $100 resistance levels for Brent crude. And long term, well, European natural gas is going to continue to maintain a very high premium risk, simply because they no longer have that cheap Russian gas buffer to fall back on.
Tactically speaking, right now, going long on crude oil and major energy stocks has emerged as one of the very few highly effective defensive plays. It's essentially acting as a vital shield to protect portfolios against the ongoing tech sector collapse, and just rising global geopolitical risk overall. It's a fascinating shift in market dynamics.
But I want to leave you with this final, critical question to chew on as you review your own strategies. The market is entirely 100% pricing in war right now. It is a very crowded trade. So, if absolutely everyone is betting on conflict, how exposed is your strategy to a sudden violent market whipsaw if a surprise peace agreement or ceasefire is announced tomorrow? In markets this volatile, the absolute biggest risk is often the exact opposite of what everyone is expecting. Thanks for joining me on this explainer, and definitely keep a very close eye on those headlines.